You want companies that can really make a difference. We had funded a company which was raising multi-hundreds of millions. They announced super results. Stock price more or less went up 10x. Your average device is saving lives at the moment. I've seen videos where they more or less dead, pull out the thrombus and they walk off the trolley.
Welcome to Leading Beyond the Lab. Today I'm very excited to be joined by Joey Mason. Welcome, Joey.
Thanks, Lawrence. A whole bunch of people are going to say, sorry, I don't like your baby, get over it. If I'm an investor, I sell money. So I want to understand numbers. Give me money. Talk about money.
What's next for you then?
Well, I've got a flight in a couple of hours' time.
You must have had some funny stories.
You just handle them as like sales objections. Oh, well, I can fix that and I can fix that. It's like, no, you can't.
So of every 100 initial pitches you go through, one of them is the one.
Maybe one, maybe two. If it's not a yes, it's a no.
In the way that they say success leaves clues, what are the clues that you've seen?
We really want a super team. It's not, it's never.
Welcome to Leading Beyond the Lab. Today I'm very excited to be joined by Joey Mason. Welcome, Joey.
Thanks, Lawrence.
Joey has 25 years of experience, is an established VC investor with multiple successful exits across some of the household names of companies that you're going to hear today. Today we're going to get an insight into the journey that he's been on, why he's in the position that he's in, what journey he's taken and the challenges that he's faced along the way, with some of the fun stories. So really excited to have you on board today.
Great. Thanks, Lawrence. Much appreciated. It's great to be here. Give you a little bit of background of what I've come and where I've come from. At the moment, I wear two hats in terms of what I do. Primary one at the minute is with Claret Capital Partners, which is a venture debt provider. I joined about a year ago now as a venture partner to look after the life sciences side of the fund, which is essentially a more formal endeavour in life sciences. The fund has done about 20 investments over the last 10 years or so in life sciences, but we're now going to deploy about a third of the new fund, which we're just raising at the moment, which has completed a second close. So we're going to be very active in the coming 2 to 3 years in on the debt side for all kinds of life sciences companies, everything from Medtech to digital health to Techbio through to biopharmaceuticals.
Sounds busy.
Very busy. So that's my half job.
What stages of company for the venture debt?
So on the debt side, they're typically revenue generating. So early stage revenues, under 5 million. They'll have got probably some regulatory approval, CE mark, FTA or something like that, and they're selling in perhaps a geography, and then they're looking to expand that. So they will almost by default they're not profitable, they're not bankable businesses. They'll typically be venture backed, and where both the founders and the venture providers want to have a form of non-dilutive financing, which is the real selling point in venture debt. And there's a lot of demand, as you'd imagine. We also do, so typically I kind of think of those kinds of companies as pure tech companies. They just happen to be in life sciences. Yeah. So, it could be, say, Techbio, it could be digital health, but they're fundamentally businesses. You can look at them as, they're sales SaaS models, or, they've service providers or whatever. But we will do some biopharmaceutical companies as well. So that's much later stage, phase 2B, really phase 3 clinical trials, where they'll be, heavily backed by the venture world, or crossover funds, where they're looking to perhaps, extend the runway for a clinical trial. Yeah. And, we've done that already. We had a really nice result recently, which I can tell you about later in Abivax. But that's where the venture debt side, huge success. Worked fantastically. But I mean, that's a real credit to the company and to the backers who had the vision. But they're the more rare occasions, but we will do that, and that'll very much depend on the syndicates that are behind those kinds of companies. So that's, and we'll look Europe, including Britain, the US.
I feel the same way.
And we've done a couple of deals in Asia, so it's global, but the fund itself is a Luxembourg fund, but our office is literally across the river here in London, just behind Victoria.
Yeah, nice. And so when you wear your two hats, as we call them, two different kind of functions of investment, what's the difference in your approach as an investor when you're wearing one hat compared to the other?
So the other hat is with Sofinnova Partners, which is a very well-known international venture fund.
Oldest in
Europe. Well, I don't think it's in the world, but certainly 50 years old.
Yeah,
and
yeah.
I
was reading that.
Kind of dates me. So Sofinnova has historically been both a Medtech and Biotech investor and has gradually expanded its strategies over the years as it's grown. So I'm now working with the team as a venture advisor in Ireland. So that kind of involves scouting the Irish universe for all sorts of companies. That one might meet any of the investment strategies which go from very early stage, like essentially incubation in Medtech and Biotech, through to crossover fund, very late stage Medtech and things in between, including things like digital medicines. So I guess the difference between debt and equity is equity, essentially you're buying a stake in a company, and so you're becoming an owner. And typically with the likes of Sofinnova and in my previous background with Delta and with them ventures, you're very active owners. You participate at the board. You're constantly in touch with management. You're looking at strategy, and you're basically a very active owner within the organizations. On the debt side, essentially, you're selling loans. Now, equity, you're selling equity. It's still a sale. You sell your fund, you sell what it can bring to a company, but you're on the debt side, you're selling a loan which has to be repaid.
Yeah.
Fundamental difference. And it means that the debt side is by default a
lower risk.
Pardon? It's different risk.
Yeah.
You're choosing later stage companies, so it should be lower risk, and it's much more important for us. If I'm thinking of when I'm thinking about what do I need to do on the debt side, you're looking at companies that you want to be sure that they can repay the loan, right? You're still taking risk because these are not profitable companies. Things go wrong, markets, flatten out, or lots of things can go wrong. Founders can fall out and all that kind of stuff. But they're meant to be lower risk, and you were just looking to get our at the very base, get the debt repaid, debt and interest. On the equity side, you're kind of hunting unicorns.
Yeah.
That's the job. You want to find the 1 in 1,000, the 1 in 500 companies that can really make a huge difference to your own fund. So that's where your ticket check size will become important. But you're looking for unicorns. So you're not, debt is more volume. On the equity side, it's rifle shots. That's it. That's the kind of difference.
And if you were you've worked with some of the most well-known and some of the newer funds, from Ventures, Sofinnova, Claret. What do you think is distinctive about Claret and their approach?
Well, on the venture debt side, and I can say it very easily, we can act very quickly. You can go from a term sheet to funding within 6-8 weeks, just depending on the complexity of the legal agreement. But once you agree a term sheet, it's really quite straightforward. It's basically you're doing documentation that is about loan securitization. You're not having discussions about options, about good lever, bad lever. You're not talking about shareholder rights, governance rights. They're not our affair.
Yeah.
We will typically observe. We'll take an observer seat in the companies. That's to listen. We will always have things like access to financial reporting. With venture debt, we would almost always get asked for a warrant, which is an option to buy shares at some stage in the future. So you want to keep an information flow. But that's really it. So it's quick. It's pretty flexible. We can be quite flexible on the terms of our offering because, unlike equity, I mean, you buy shares, you have your coupon, you might have a double dip, whatever. But they're fairly, the instruments are you've limited room for maneuver on what you can after because you're buying shares. On the debt side, you can kind of look at things like interest rates, warrant cover, interest-only periods. We typically have an interest-only period for the companies of at least a year. You can extend that. You can extend the loans, and you can tranche investments, all that kind of stuff. So there's ways you can do, and it's pretty much in conversation with the companies, like, well, what do you want? When do you want the money? How do you want it, etc. So we can move quickly. It's a small organization, so we can actually make decisions quickly too, which is a different thing, right?
Not always the case.
Yeah, and I guess the pro and con we're a fund, so we raise funds from LPs in the same way that venture does, but that's our product. It's a fund. We don't have a bank behind us, so we don't have any requirements on the companies to bank with us, to have any other kind of covenants and things like that. So we can it's the good and bad thing about the product. It's pretty vanilla. It's what it is with what we have out there. So you don't have to look under it to see, well, what are the hooks are going to be in there, or what are the demands on the company.
And with your other role with Sofinnova, where you're scouring effectively for good targets, companies and things in the Irish market. Now, I've always felt, certainly in recent times, there's a lot of big companies moving there to manufacture and do big projects, but typically towards the latter end of drug development and things like that. But not necessarily on the R&D side. And there's some big success stories. I know, like Amrit, for example, that you were involved in, that we talked about previously. We worked with. How'd you go around that? Is there a big growth in that side of things? I'd love to hear your thoughts around that.
So, say on the equity side, it's a completely different product. You're looking to try and find what can be world-class companies opening up a niche, or being dominant in a particular niche, and what I'm typically looking for in the Irish context are either medtech companies, biotech companies. Broadly speaking, they're the most. There are some what you might call Techbio digital health companies too, but the bulk of them are going to be in the medtech and the biotech. On the medtech side, I mean, medtech has been in place as a kind of as an ecosystem. It's been growing since early 1990s, and that was on the back of the likes of Boston Scientific, Abbott, Johnson Johnson, Medtronic, who did set up manufacturing originally. But with medtech, you can basically start spinning out, getting people who've got experience in as a biomedical engineer, and they will start coming up. Oh, we can fix that, or we can fix that.
So you're trying to find new problems that need to be solved with these new companies.
Absolutely, there's been a huge effort in terms of policy, and can I say hand on heart, there's an organisation, and this is from the government. This is through an organisation called Enterprise Ireland, particular, which is the indigenous. It's the indigenous organisation to support indigenous companies.
Is that the public board you sit on?
Pardon?
Is that because I noticed that you sat on a number of private and public boards effectively?
No, I've never sat on an EI board. They actually also are LPs in funds, so they've done it's a really interesting group, but they're incredibly supportive, and they've put policy in place. They've put structures in place. For example, they were major funders of BioInnovate, which is a program that Galway University hosts, where it's boot camp to learn how to develop a medical device company for a year, and they've teams of 3 biomedical engineer plus a medic plus others, and they've been doing it for more than 10 years. So I was on the first board of that as an advisor, and it's remarkable to see what you can do in 10 years, but it takes constant support. So I have to say hats off to the likes of EI for that. It's been tremendous. And so I would say the medtech sector in Ireland is really it's getting quite mature. And it'll take all sorts of different, you can almost step in at any size of company that you want at this stage. And so that's become a really strong ecosystem. So it's very easy for me now with my Sofinnova hat to go and look and chat to all the folks on the Medtech side. It's pretty well organized. There are good angel networks. It's structured, and you can see, and some big companies. I mean, one of my big investments was a company called Uravi, which was ultimately acquired by J&J for neurovascular thrombectomy device to pull out strokes. I mean, that was one of the banner exits of the year in its time, and that team has then gone out and done a whole bunch of other things, and some of them are still with J&J. They rolled into a group called Sofinnova, and so there's a lot of the right things are in place. The tax helped, I've no doubt, to keep the likes of a Boston, etc. Medtronic actually is it's headquartered in Ireland, as are a few other very large organisations, but there's a very, very significant presence. On the biotech side, it's slightly different. There has been manufacturing in Ireland for donkey's years. I mean, literally, again, that was the other. Some
incredible engineers come across working mainland Europe from Ireland.
Well, this again came the reason that the Bostons and the J&Js were brought in by a group called the IDA, the Industrial Development Authority, which is the state body for foreign direct investment. So they attract all these companies. Same with Intel, Facebook, all these. That's their role, and they've been very successful at it. But they targeted pharma manufacturing probably 40 years ago, and very successfly. So the likes of Pfizer's Viagra was at one stage Ireland was the worldwide site for it.
Oh, was it? I didn't know that.
Yeah, it was all made down in Cork.
They discovered it near where I live in Sandwich, didn't they?
Oh, really?
Yeah.
In Sandwich in Kent.
Which is where Pfizer had big setup. It's the only thing there, really. But
that's right.
Because I grew up in Broadstairs nearby. Claim to fame for the southeast of England.
And why not? And then gradually, small molecules gave way to biomanufacturing, and there's some very big biomanufacturing plants in Ireland, and so it's kept Ireland at the forefront of manufacturing. Cell and gene therapy is beginning to come that way, but it's a little bit further away. It's not. They're not. The market hasn't fully developed yet, but there's always been a very strong, call it industrial base. Lots of jobs, high-paying jobs. PhDs. But on the R&D and innovation side,
within therapeutics,
not as well organised or supported. And part of it was just simply if you think of, Ireland has 5 million people. It's the size of Manchester.
It's crazy.
It's
punching well above his weight specifically in that regard.
So if you're thinking of where R&D spend is at university here, the UK has a phenomenal infrastructure and obviously a huge, well-deserved reputation for pharma biotech development over the decades, and you've the big funders, including the likes of the Wellcome Trust, for example. That's you can't.
If anything, it's
you wouldn't want to
better.
compete that. You can't compete with that. Certainly not if you're in the public world. And so the companies have had to make their way in different ways. The innovator companies. So the likes of Elan, I don't know if you remember that. It was a drug development company originally. That spun out a whole load of companies that were. Trained people to start their own companies, and so there's a kind of a network that comes out of that. Warner Galen, or Warner Chilcott as it was, another network that comes out of all of that. But they've had to find their own way more than the Medtech world. Whereas you come over here and the BIA and all these kinds of, they're much more obviously organised. Oxford networks, all these things, they're there and they're visible.
There's a massive hub there in Oxford.
And Oxford, Cambridge, and then you go up to out to the regions, and it's. So what about? So if I was to say to you, what's your top success that makes you feel good, and obviously, from an investment perspective, was a significant success, and also came with it a big impact that it made. What one would stand out? Well, it's kind of funny. There's an old joke in the venture world, what's your best investment? My next one. And it's a bit of truism about all those things. So
the feeling gets superseded by the last one.
You're always thinking, the next one will be greater, and the next one will be better. And I mean, I think of success is on a monetary perspective, the outcome in Nuravi was definitely the best one I had. But that was Nuravi. I mean, I just happened to be, I'd say, lucky to have invested and to be part of the journey and support them.
Yeah.
I mean, we'd recently, with my Claret hat on, we had funded a company, which I mentioned earlier, Abivax, which was raising a very large round to fund phase 3 trials in ulcerative colitis and Crohn's disease.
Mm-hmm.
And like you're talking multi-hundreds of millions of euro and dollars for those funds, or for those trials. And that was with a very strong investor group. In fact, Sofinnova Partners were essentially the lead of that, and that was before I joined. So it's kind of ironic. But they announced super results about a month ago or so for their first phase 3 in Crohn's, and the stock price more or less went up 10x. And so that's been a great success. The drug isn't on the market. I mean, Nuravi's device is saving lives at the moment. It's a thrombectomy device. So literally people go in with a stroke. I've seen videos where they more or less dead. They pull out the thrombus and they walk off the trolley.
Yeah.
I mean, it's just staggering. But my first investment was, as a venture guy, was in a gene therapy for retinitis pigmentosa. 2005. It was definitely too early, but they were a great team. And I, would I make the same mistake again? Probably.
Yeah.
And the mistake was that it was just too early.
Yeah.
And there was an awful lot to be done. The technology was very early, and so much has changed over the intervening years. I guess it's like anything, you learn more from your mistakes than you do from the successes.
Isn't that the truth? Yeah.
That's the way it is. But with all, I mean, you're kind of, so I say with the venture hat, you're looking for unicorns. You want companies that can really make a difference.
So what are the in the way that they say success leaves clues? I know you have to have a portfolio of companies to get that successful exit, or the company that makes the difference. What are the clues that you've seen that seem to be consistent among those successful ones?
I think there's tangible ones and there's kind of intangible ones. The tangible ones are fairly straightforward. You really want a super team. And team, it's not a person. It's never a person.
Yeah.
And
so what does that look like, though? Break that down a little bit.
It depends for the stage of the company. But certainly at an earlier stage, you want to have people who understand the process, the business that they're in.
Yeah.
So they need to be experienced in the Medtech or Biotech or digital health world. They need to understand what their customers want, how you sell stuff, how you get product to market, what the regulations are. Maybe not have done a lot of it. That's not a requirement. But they need to know what business they're in. It's not for novices. And venture money doesn't train anybody. It's way too expensive to train people. It's delusional to think that that's the right use of funding. And so when you're looking at very early stage, you want at least 2 or 3 people who really understand the process, really understand
I've been there
their
and done
industry,
it before.
have been there. They don't necessarily have had to have a great success, because success can be a bit random. They need to know when to cut their losses, which is a different, thing.
So does that depend, though, whether if it's a CEO, they probably do need to have been there before, but if they're
you hope,
if they're on the technical
they
side,
they could have been a team leader in a P&L. In a larger company.
Yeah, that's good.
I mean, when you're in CEO, so CEOs it's a main job is selling, and if they understand that, that's great. But then the other parts of CEO is like, well, how do you run a business?
Yeah.
How do you hire people? How do you organize yourselves? How do you scale? How do you actually make sure you've all the steps in place for what is a complicated? Doesn't matter what product you're talking about; they are complex. How do you get a board? How do you manage the board? How do you
get out I always think one of the common signs I see with CEOs that I work with is once they've done what they need to do initially and made that big change and made key hires and certain key pivotal C-suite level hires, they almost get out of their way. I think that's a big part.
Yeah. Yes.
And are able to do that.
A small anecdote. So there was one of my previous lives, I worked doing investment banking in the CRO world. So I worked for a small boutique here in London. Gosh, for my stupidity, I thought it was the market was already done by the time I left in 1995. So I was, definitely naive. But I met this CEO, and he had already started this CRO business, which was growing nicely, and acquired a company that I was representing. And he was a biostatistician from, he was a prof from Durham in North Carolina, and he had his own business. He started it. And I remember chatting to him after they'd made the acquisition, and it was like, how do you've moved from academia into what is a very commercial role?
Yeah,
and he says, like, how do the board view you? I mean, because are you, they're waiting for the new CEO to come out. And he said he manages it. His way of managing it is he says to the board, look, I'm learning here. I'm prepared to learn, and I will learn. But when you think it's right for somebody else to come in, just we'll do that. And so we kind of disarmed the board, and he said, I'm ready to learn. Now it turns out he was a spectacularly good CEO, and the company, like one of the rarities, and that company grew and grew. I mean, it was a huge success. But he had that self-awareness to be able to say, I'm part of a bigger thing. I can do my bit and I will learn, but we need to put other really strong people around me. And so I can do my bit very well because I'll understand fundamentally a lot of our product, but then I'll have the right people who will support and we'll grow as a team. And
that humility probably was one of the key reasons
really
he was a good CEO.
Yeah. And it's not false humility. He was steel. I mean, he knew what he knew. He was good at certain things, like really strong at them, and he was also had very strong business acumen, but he wasn't the humility to know I don't know everything, I won't know everything, but I need to know enough. And I think that's where you're always kind of trying to balance it. And some CEOs are great at startups because they love doing everything. They love the whole buzz of doing a bit of research, a bit of IP, a bit of sales, a bit of this, and then by the time it gets to 3 years down and they kind of, have groups, you have somebody running manufacturing, you have somebody running, bored. It's like, and they get bored. It's like, and then it's like, okay, it's time to move on,
And it's, what I like about that is they know their strengths and they're okay with then having to move on.
Yeah.
But you must have situations where
they're mature enough to know that.
to move on.
Oh yeah.
And that can be difficult, right?
Yeah, certainly. So I've founded on 20 odd boards, and just about every venture board comes a time for the CEO to move on.
Yeah.
And certainly when I'm sitting on boards,
or move sideways, or move to a different role.
Very hard to move sideways.
Yeah.
It's great in theory. It can happen, but it's because then that person has to have the ability and humility to be able to say, well, okay, look, maybe I'm a great inventor. Okay, so I'll be doing the tech side or the CMO, or I'll do that's where my role might be, and I would enjoy doing that, and I just don't want to do the whole selling bit, the shareholder bit, the biz dev bit, and that's tough. It's a tough place to be.
And so, what are the key traits if for listeners, for say an early stage company? What would be your key lessons or tips, if you like, on how to go about leadership in an early stage company?
So I think, firstly, just to appreciate that it is a team effort, and nobody has all the answers, And so if you start with an organization chart of what you might be in 2 years' time. There'll be roles, and understand what the roles are, and say, okay, well, I can fulfill 20% of it. Our team today can do 30 or 40% of that, and there'll be a big gap perhaps in finance or something like that. And say, okay, and then you're talking to investors, say, here's what we have today. We know we need to get to here at this, this structure, and that I don't think a lot of people think like that, because you have to plan. Then nothing happens in a day. I mean, you're in the recruitment business. It's like, we need a new CTO. tomorrow. Oh, really? Okay, well, like that's, you should have
3
planted
month
that
notice
tree
period,
20
yeah.
years ago. It's just, it's going to be 9 months,
Yeah.
and what are you going to do to get by? So it's an appreciation of what it takes and the various stages to get your organization correct. So that's kind of understanding that it is a team effort. And by the way, part of it, and if you hire the right people, I mean, Ravi, for example, found very carefully went after a particular colleague who she brought just an incredible insight into the regulatory side of things, deep experience, and she saved the company like 6-9 months in the regulatory pathway, which is worth millions.
Yeah.
And so if you get the right, and you're overhiring, so that was an overhire at the time.
They fill in the right.
But it was to be, you're playing yourself forward. It's not
the mandate fills into the person. Yeah, I know what you're saying.
And as you grow, you're going to need people who understand. If you're in the biotech world or the medtech world, you need to find people who understand how the industry works, perhaps, and who've played a part. And your board can play a big role in that. But I say, so if you're beginning to think about your own company, so it's not what do we need today, it's what do I need in a year and in 2 years, because that's really what we're asking people to invest for, so that we can hire these people. That's one of the more obvious things that people don't necessarily think about. If they're the founders, and particularly if they have an academic background, trying to understand that you need to be dispassionate about your technology, whatever it is.
What do you mean by dispassionate?
You have to be objective about it.
Oh, okay. So almost empathising with the person you're talking to.
Correct.
Thinking what they want to hear about it rather than the.
Well,
the
no,
detail.
I'm saying the wrong way. You say, at a given stage, you present what you've got, and maybe for your life's work.
Yeah.
And
this is
a whole bunch of people are going to say, "Sorry, I don't like your baby," just get over it. Just really, venture is a game of numbers. If I'm wearing my venture hat, we have done 1, 2, and 100 deals. So that means we didn't do 98.
Wow,
so if you're on the other side of that, to get an investment,
so
you need to see a lot of people.
That. So of every 100 initial pitches you go through, one of them is the one that.
Maybe one, maybe two. That's a kind of average. It's 2%.
So how many pitches do you have to listen to a week, or should you listen to a week?
Well, God, on a weekly basis, that's probably too small. But and you won't necessarily see the pitches. You'll have the information. You'll see decks. You say no. I'd like to see that one. Yeah.
So and how many of those do you take through to pitch?
You'll be seeing hundreds a year, thousands a year, perhaps. I mean, I know. Wow. In Sofinnova it's thousands. And also Claret, because it's slightly different. It's a smaller number. But even Claret, our deals, we will still do like less than 5%.
I bet you've had some incredibly good pitches. Yeah, and what makes a really good pitch? I'll start with that side.
Well, the outcome of a good pitch.
Because how long do they get?
Is a decision to, typically half an hour or so.
How long
like
before I imagine that's half an hour to have the conversation, but there's probably a period at the front end.
Oh, first slide. Yeah.
So they want to grab you.
I mean, typically we all have ADHD. It's like completely. If you don't get attention very quickly and want somebody to turn the next page, it's like you've lost it. You just have lost, you've lost the audience.
Then what's the tip there? What's the thing that the good ones tend to just? How do they grab you in or hook you in?
Well,
if you're an early
immediately will focus on what's important. They understand who's sitting across from them. Like if I'm an investor, I sell money. Yeah. So I want to understand numbers. Mm-hmm. Give me money. Talk about money. How, market sizes. What's the potential exit opportunity? How much is it going to cost us to get there? Talk in language that I need to use when I am pitching to my colleagues, because that's what they need to understand. We're funds. We invest cash to get cash back. That's fundamentally a bit, and a lot of companies make a terrible mistake.
So it's like problem you're solving, potential upside, here's a breakdown, and I'm about to deliver my plan to you, and how I'm going to get there kind of thing. How much money you'll make.
And it's literally, I would have how much money you're going to make. You're going to make money with me. That's the fundamental.
And so what?
And an awful lot of companies give you science lessons.
Science,
They say,
yeah.
here we're solving the
Yeah, I
world's
suppose
problems.
it's easily done,
like,
isn't it? Because they're
God,
coming
seriously.
from if they're very profound, they're a thought leader in a certain space. Like you say, they devote their whole life to something which becomes another child.
Mhm.
Then it's very easy for it to fall in that direction.
Yeah, and it
So
can
it's
be,
about being aware of that.
fascinating what they're doing,
Yeah.
but like that's not what our job is. We've to try and sift out and figure out for our fun. And again, this is back to I would call it knowing your customer.
Yeah.
There is no point in pitching an investment to say a company that has no funds. And it's perfectly legitimate question as a clearance question. It's great to meet you. Do you have any money? Oh, we're not actively investing at the moment. Thanks.
Yeah.
Move on. And that's one of your 100, by the way. There'll be an awful lot of companies who just simply aren't in the market. And then what do you like? You can see from websites where we don't hide what we do and say, oh, okay, yeah, those folks, they like to do. I can see they're typically earlier stage. They do one per therapeutic area,
Sounds like my
so
job.
they don't do a whole variety of things. Yeah,
From research.
it's very simple, and in this day and age, it's very simple to do that.
Yeah.
And it's essentially probably remiss not to do it. And for example, if somebody says, "Oh, I want to talk to that company, that fund, because they've made an investment in the area," and you're like, they can't talk to you. They're competitive. Like they won't. They might ask you for a load of information, but they can't invest in you. So just be smart about it.
I can really relate there with. So if I'm talking to a big pharma company or a big medical device company, and we're doing a big search for them, the questions I'm asking and the things I need to understand are much different than if I'm working with like an academic spin-off that's raised a Series A or seed round. And the scientific narrative, the leadership team is much more important there in many respects.
But by the way, that's also really important when we're looking at these companies, because ultimately the acquirers are the large biopharma or medtech companies, broadly speaking. I mean, that's so we need to be able to, if you're kind of assessing people all the time, it's like, okay, you've got to understand what our money wants, but ultimately, we make investments. We're trying to support the business and see it through. But we need to see that you can then move that on. It doesn't necessarily sell the whole company, but that you can do a business relationship with a large pharma or a large medtech, understanding this takes 3 years. So who am I going to be talking to at least? How do I begin to position that? How do I make the company and that pitch look right for them? Because that's very different to an institutional investor. Different bells. Strategics want strategic value, and so you're constantly adjusting your selling pitch to the various audiences. You wouldn't give an investor pitch as, for example, a lecture to a bunch of undergrads about what your company does. You'd be telling them, well, here's the science solving this problem, and it's wonderful, and which is great. That is entirely appropriate for that audience. One deck doesn't meet all the various constituents.
And you must have had some funny stories as well from pitches. Is there anything that stands out that will amuse the audience and myself?
Oh God. Oh, sorry. Yeah, no. I mean, sorry. They're just painful. I mean, you kind of think it's like, God, just get me out of here. I mean, but it's a hint when the investors start asking you questions about things that are entirely unrelated to your business, like they've lost interest. So
really? Is that?
Oh yeah. That'll be like once they stop listening, and they want to know about the competition, or they want because they've tuned out of your meeting. No, I mean, sorry. The things that you meant for not so much the pitches. It's being tone deaf to the questions. And it's a tip if people want, never pitch by yourself. You can't pitch and listen at the same time. And I've done it. I mean, I have a buddy who used to come pitching with me when we were doing our funds or doing this stuff, and he'd kick me. It's like, shut up, Joey. What he meant was this, by the way, when you asked that very pointed question. But when you're selling, you don't really... You can't interpret the question. And certainly if you're not a natural English speaker and all the pitches are in English.
That's true,
there's opportunities for miscommunication across the whole thing. But there was one particular guy who
you get 2 ears. You get 2 ears for listening and 1 mouth for speaking for a reason. That's what my mother always told me. It stopped me well in sales as well with Arthur. Yeah.
No, so you were asking about funny pitches. And I will remember there's one guy who was coming in from another sector, and he was from the mining sector or something. And everything we said about, why this was not necessarily an easiest opportunity to invest, which are all I would call them constructive comments. He just handled them as like sales objections. Oh, well, I can fix that and I can fix that. It's like, no, you can't. Like, this is basic science, or there's no marketism. Like, you can't fix that. And don't, like, it's almost like non-reflective. It was I'm going to sell you this. And if you don't want that, well, I've got another watch I can sell you here, mate. And you're like, oh,
so someone turning up your doorstep to do your driveway.
And then you're just like, please go away. Stop. So
I've had a C-suite person.
But by the way, we do the same. I mean, I know I've been at pitches where the venture folks are telling the companies about their market, and I know from the reception, having been at the other side, it's like, you complete jerks. You haven't a clue what you're talking about. So it does cut both ways. You have to be, I think maybe it's just as I'm getting older, you a bit more cautious about what what feedback you're giving. And by the way, that then turns into what is one of the biggest problems for in founders. It's what the hell. A venture has about 1,000 ways to say no and just doesn't use the word no. It's like, oh yeah, it's on our list, or we're going to get there, or we're talking to people about it, or hold with us that. All these things that are like, does that mean they're looking at it? Are they not looking at it? Are they serious
Which is hard
about
for the founders, right?
It's impossible.
Yeah.
Somebody has to say something. No, it's no. And so
that's probably all they want, really.
A couple of rules in my own mind, again, when I'm pitching myself for companies that I work with. If it's not a yes, it's a no. So unless you hear yes, it's no. And then just move on.
And yes is usually yes. Oh, that's interesting. Let's have another conversation.
You were asking what success. Success is you get to the next conversation, you start, and real success is people start going into your diligence, into your data room and start doing work. If they allocate resource, you've got a bite. Not a hook, but you've got something on the bike. Or you've got a bite. And so that's it's like protecting yourself as you're pitching. It's like, assume it's 1 in 100 or 2 in 100, and so I need to hear. I'm assuming no, unless I hear yes, it's no, and then move and act accordingly.
Nice. And so what's next for you then? What's the big plan?
Well, I've got a flight in a couple of hours' time going home. I'm just so I started with Claret a year ago, and with Sofinnova slightly less than that. So I have an awful lot of building to do over the next couple of years. So I'm not going anywhere. Been out there, conferences, back into conference season.
Yeah,
in
we
September.
really are, aren't we?
Everything gets quiet in the summer, and it'll just go rah until Thanksgiving, and then get quiet again until JPM, and then rah again.
So you're going to be in London more at the moment?
Oh yeah, in and out the whole time. Yeah.
And do you have a place here, or?
No, I commute.
Live in Dublin. Well, I've got time for one more question.
Go.
So we've had some great stories and insights. What would be? I'd love to tap into the Abivax success, if you like, and what you think was a differentiator there that people could tag onto.
Data. Basically, they had a really strong product with very good signal through phase 2. So that was where we got involved. And once you have that, forgetting everything else organizationally.
So was that luck, or was there something you found that was there, though, that was...
Oh, well, they had, by the time we got to it, that was what they had. And Abivax had been through a few maneuvers. I think it started, as the name might suggest, as a vaccine company. Yeah. So they maneuvered their way around. So what they had was, they'd come across this product, and they'd been smart enough to understand what the opportunity was. But they were in very large disease application. I mean, these are huge markets, huge trials, right? So but the data was very strong, and the safety profile was very good. So you're trying to handicap what the likelihood of success of a drug will be in phase 3. It's way beyond my pay grade. I couldn't tell you. But they had a very good opportunity. And basically, there was a signal that we felt would be, it was a very good chance that it would turn into a stronger signal once the noise went out. They'd also a really, really good team, and they were building out on the team as the company was moving through these various stages. It had gone from the founder-led or founder-investor-led, in fact, and it transitioned into a more kind of next generation type of company where there were more folks around the table. They'd also begun to attract US investors into the shareholder registry, so there was financial support in it. But as a team themselves, they had an awful lot of top people. They while we were doing the deal, attracted a very strong CEO, changed out the chair. So they transitioned. They were able to, and as the people that were coming in, it was a bit like in your Abbey experience, when you see very seasoned professionals coming into a risky company. They've looked at the data.
Yeah, I always think that myself.
They've done their calls. I mean,
they've done their own due diligence.
We've money, and okay, you make your portfolio bets. They're committing their life, so that's way more expensive if you think about it, because that's really time they can't get back.
Yeah.
So if people make a commitment with their life, with their time, that's a very strong signal, and so that's why people pay so much attention to what's the team.
I find that all the time, especially early stage companies.
Yeah, it's very important. So then, once you're in, but they managed as a group, which it's still not a big company. They're managing some very sophisticated, very large clinical trials. That's not trivial. I mean, that is a really, really big challenge, and they did that very successfully and in the public eye. So, with private companies, you can hide a lot of sins. You don't have to report every quarter. You're reporting, and Abivax were doing that and managed to keep. I would say the market on side to an extent. Very hard. They solved their problem of the stock market, fluctuations and what it did to share pricing by basically raising enough capital to complete the trials. So that was really smart. They weren't constantly going back drip, and that had been a factor in their prior history where they're almost always running out of money. And
so is that I worked with a CEO once, and he said he came from a finance background, and he was a proven CEO who had had 2 or 3 successful exits. He told me, and it stuck with me, this is about 3 or 4 years ago, the best time to raise funds is when you've just raised a fund. Raised a round of funds.
Yeah.
Because you don't really stop. And does that kind of play into what you were just saying, where you kind of always, you're giving yourself a buffer almost at all times?
Totally. And I mean, if people always say there's a European disease, which is, dole out dollars, can snuff it awake. It's like bit by bit. Whereas in the US, it's like, okay, you need money to get to, 2 years' time. Here's the money. Just, you might blow your brains out, but at least you have the money. You're not spending your time trying to constantly raise. And as the CEO, that's what you spend your life doing. You're basically spending an awful lot of time doing investor relations and raising money. And so if you can get money quickly, one of the big successes for us with Claret was in a medical device company, a company called Endomagnetics, which was doing relatively, it had bootstrapped itself and finally got Moulton to come on board, which was great for them, and they're selling about $10 million when they came to us. They needed finance so they could create some opportunities, because they had potential M&A interest and potential other investor interest, but they weren't strong enough as an organization to make big decisions yet. So the venture debt allowed them to buy 9 months a year of breathing space, really, where they were able to continue to increase their sales and then they got to a value inflection point that was really much stronger than if they had tried to do the same thing a couple of the months when we started, and so that was having a capital base that allowed them to basically do their strategic plan, and that was that's a kind of sweet spot. That's where the companies get sufficient capital to do what they need to do. By the time our debt was essentially repaid, they could have raised more money without a problem. But they'd given themselves the chance to do it without having to be. Sorry, the alternative was to be constantly out there, constantly saying, "We need money here, we need money there," and that's that really hurts businesses.
Yeah. And
So being properly financed, they were properly financed.
It probably impacts good decision making as well.
Well, it does. It totally impacts.
Emotion gets involved, doesn't it? I suppose.
Well, it's not so much emotion.
Short-term thinking.
It's short-term.
Thinking.
They're trying to think of what do I do? How do I get at it? How do I fix this problem?
Hole.
Yeah, fill the hole. Exactly.
Final thing,
Cool.
just on the softer side, with this stressful life that you lead, how do you unwind?
I go on holidays like I did the last couple of weeks.
Any hobbies?
I do a lot of
Ireland's a
things.
beautiful place. The weather's not great, but it's beautiful.
Sail a lot, run,
Are you a runner?
water ski.
Do marathons? Or?
I'm doing a half marathon next month and do a sort of mountainy
Nice.
stuff as well a bit. Nothing serious. This is I like running this morning in Hyde Park because it's call
good,
it
though.
sanity running.
Yeah.
Kind of plodding. But you can put your shoes and runners into a bag and go anywhere. It's great.
It is true. It's a good way to see that, and it's a good way to see everything, isn't it?
Absolutely. Yeah.
And it's faster than walking. So.
Yeah.
Well, thank you so much for joining us today.
Not at
It's been
all.
really fun.
Thanks, Lawrence.
I really appreciate your time.
Okay. Thank you.